Taxes, taxes, taxes. We all got to pay them. But the question is, how much do we have to pay? If I make more, do I have to pay more? And how come I received a higher tax refund last year than I did this year? If you don't know how income taxes work, look no further. We'll be covering it in today's video. Because until you understand how much you're obligated to pay each year, you won't be able to properly manage your money. Welcome to Finance for Everyday People. I'm Jeff Mora, where I teach you all about your personal finances like you should have been taught. So this is a fun topic because understanding income taxes actually bleeds into a lot of other subjects in your personal finance journey. To start us off, let's go over some very basic definitions. A tax is just money collected by the government to pay for everyday public services, roads, schools, first responders, and much more. Income tax specifically is how much the government charged you on the money you earn, whether that's through your salary, hourly wages, bonuses, tips, and other forms of income. We're going to focus our attention on this topic, this video, but as a teaser, it's really important to understand income tax so that in a later video, I can go over capital gains tax, since that's calculated based on your income. Let's start with gross income. A simple example of this is how much your employer is agreeing to pay you when you first take a job. So if I get offered a job that pays $80,000 a year, then that $80,000 is my gross income. Taxable income is the amount that you're actually getting taxed on, and it's usually not that full $80,000. And the way that gets determined is by subtracting any deductions from your gross income. So gross income subtract deduction equals taxable income. The higher the total amount of deductions, the lower the taxable income. And we can easily illustrate this. If someone makes $80,000 a year, and then each tax season they claim the standard deduction, then the taxable income is $65,000. I won't dive too deep into deductions, but most people take the standard deduction anyways, which for 2025 was about $15,000. You can itemize deductions, things like how much you donated that year or how much you paid in mortgage interest. But for most people, the standard deduction ends up being higher anyways. Great. So now we know how taxable income gets calculated. But the question still remains is, how much do we actually get taxed? You might have heard of tax brackets. Let's go over it. I'll throw up the 2026 income brackets since they are the most recent, but understand that there's a difference between single filers and married filing jointly. This is how you file for taxes depending on your status, but we'll stick for single filers just to keep things simple. If you take a glance at these tax brackets, the first thing you'll notice is that they go up with the amount you make. So for 2026, the highest someone can get taxed is 37%, and that's only if they're making over $640,000 a year. Using this grid, you can see how much you actually owe in taxes, and I'm specifying 2026 since each year they can slightly change. But the biggest misconception people have when it comes to tax brackets is assuming that the range they land on based on their salary is how much they're paying on their entire salary. It's a waterfall effect where as your income increases, then only those jumps get taxed that rate. And to break this down, I'll actually go into a simple example. Let's look back at our character who makes $80,000 a year. They take the standard deduction, and now their taxable income is $65,000. Jumping into our tax brackets for 2026, we see that $65,000 in taxable income falls under the 22% tax rate. But that does not mean they pay 22% on the whole $65,000. What happens is, for that first $12,400, which is that first bracket, they pay 10%. And if we look on the right, we see that that's a total of $1,240 they have to pay on tax. Now for everything above that, up to $50,400, they're paying 12%. And so that's a total of $38,000 they've made that gets taxed at 12%, equating to $4,560. Finally, we've reached the 22% tax rate. And this is the last tax rate they fall into. If they make over $50,400 and less than 105,700, then they pay 22%. Since their taxable income is only 65,000, that now only leaves a total of 14,600 being taxed at 22%. And where that leaves us is with $3,212. So you can see at different levels of your income, you're getting taxed different rates, thus making the total amount you owe at each range different. If we sum up each of those three numbers, we can see the total tax owed on $65,000 is just over $9,000. That's why it's a myth when you hear people say, oh, I don't want to make too much money because I'll get taxed more than if I made less. You'll get taxed more in total, but if you made $50,000 versus $65,000, you can see that just based off this system, they're both being taxed the same amount for those first $50,000, no matter what. To help clean this up, we'll introduce a few more terms. For the person with taxable income of $65,000, they landed at the 22% rate, which only applied to that $14,600, but that 22% they landed on is what we call the marginal tax rate. It's the tax rate applied to the last dollar you earned. Your effective tax rate is the actual math of how much you pay in total for taxes versus your total taxable income. In our 65K example, the person had to pay $9,000 in total, meaning their effective tax rate lands at about 13.9%. And yes, that's a real example of someone who would make $80,000 in gross income. Now, that might be very intimidating, but the good news is you don't have to do all that math yourself. In fact, if you're earning a regular paycheck, then chances are your employer already has their payroll system set up so that taxes are being withheld from your paycheck throughout the year. You might have noticed on your pay slip, you'll see things like taxes, Medicare, Social Security, all being removed from your total paycheck. These tax withholdings is the money your employer is purposely holding off on giving to you so that they can send it directly to the IRS throughout the year on your behalf. That way, you're not juggling through all this math to help you calculate how much you owe to the government every tax season. Instead of having to pay that large amount in bulk, you're actually paying a little bit of it throughout the year. And all this math gets finalized when you submit your tax return every tax season. Because it's not until then you actually look at your whole year's summary of here's how much I made, here's how much I already paid in taxes from the withholdings, here's how much I actually owe in total. And when we take into consideration all those little payments we've been making that go towards the total amount of tax we owe, that then results in what we all know and love, our tax refund. Because if everything we've been withholding is more than what we actually owe, then we can expect to get that refund after we file our tax return. Because it really is just a refund. In our example where someone is actually taxed $9,000, but throughout the year they've paid a total of $10,000 with the withholdings, then they deserve that $1,000 back. The opposite is true too, however. It's totally possible that if you owe $9,000, but throughout the year, only $8,500 has been withheld, then you actually need to pay another $500 after filing your tax return. And paying the IRS every tax season is actually more the case for those who never had anything withheld. For those who are self-employed or a contractor, then chances are when you're getting paid, you're taking that whole paycheck in full without leaving anything on the table. And without leaving anything on the table for the IRS, then when it comes time for your tax return, you're going to be left with a big hefty bill. And that's it. That's pretty much how your income taxes work. If this is a new concept for you and you don't understand it fully, then please leave some questions in the comments. I'll get to them as soon as I can. In a later video where I explain capital gains tax, it builds off of income tax. So you won't be able to understand that until you fully understand this one. I hope you enjoyed the content in this video, and next time when it comes to your taxes, you'll have an idea of how much you're actually owing and why you owe that much. Be on the lookout for that next video, and I'll catch you next time.